Hello and welcome to today's video. In this video, we will be discussing about the checklists before you invest. So, what is exactly a checklist? A checklist is a set of criteria that you need to check. Are you ticking on these parameters before you set out to invest in a particular product? So, if the particular product meets one of these criteria, or maybe if all of these criteria, then probably that's a best or a good investment for you. If it doesn't, then probably it's not a good investment for you. So, we'll be discussing the checklist and everything that you need to see before you put your money on a particular product to invest. So, what are these? Stay right here. We'll discuss, we'll see everything. So, stay tuned. So checklist number 1, present value or the future value. So the concept is very simple. I'll make a detailed video on this present value, future value sometime later on. But just for now, you should understand that if you're investing on a particular product, say a company who is selling you a policy, or say a company who is selling you a financial product, or whatever he is selling, you should always bring all the finances down to one particular date. That is the baseline for present and future value. What does this mean? That means the company might tell you, you pay premium for 10 years and then after 10 years you do not have to pay any more premium for the next 10 years. So that's a 20 years gap. After 20 years you'll get back this much amount of money, say some X. So what you need to do is, whatever premiums you're paying every year, say if you bring them back to the present value, which is today. So today is 3rd of April 2022 when I'm shooting this video. So you bring all the amounts that you have paid back to today, all your investments and also the return that you're getting after 20 years. Bring everything back to 3rd of April 2022 and find out how much you have paid and how much you got back. If it is more, it's a profitable deal. If it's not, it's a deal with a loss. Stay away from it. Similarly with the future value, either way, you can either push all the investments or all the amount to the future value. So 20 years later, if the company is promising you to give you something around 1 or 2 crores, push all your investments back to 20 years and see how much it adds up profit. If you are paying less, if you're getting more, that's a profit. So this is the basic concept of present value and future value. Bring all your investments to one particular date and compare. I am paying 10 rupees, I'm getting back 11 rupees, that's a profit. I'm paying 10 rupees, I'm getting back 9 rupees, that's a loss. So I'm not investing in this. That's the basic concept. That's checklist number 1. This is the first thing that you should be checking in all investments. Checklist number 2, beating inflation. Again, if the returns promised by the company doesn't beat the inflation, it doesn't make sense to invest in that product. Products like fixed deposits in 2022, they don't beat inflation. So it doesn't make sense to invest in fixed deposits anymore, at least for now. I don't know what's going to happen in future, but at least for now, it doesn't make sense to invest in fixed deposits because it doesn't even beat the inflation. Opportunity cost, that's option number 3, checklist number 3. What is an opportunity cost? Opportunity cost is something which, say, I'll take a very simple example. Say you have 10,000 rupees with you to invest. Okay, you have 2 to 3 different choices. One choice, you'll get 5 or 6% returns from option A. From option B, you're going to get something around 7 or 8% returns. From option C, you're going to get around 10-12% returns. So when you know you have 3 options, and when you know that you have an option C from where you can get 12% returns, why would you go for option A that's going to give you 5 to 6% return? It doesn't make any sense. This is called the opportunity cost. So if someone is offering you option A and saying that you're going to get 6% return, there is an opportunity with you already available, you know it, and that opportunity is option C, wherein you can get 12% returns out of it. So the opportunity cost is almost 6%, isn't it? You're getting 6%, there you're getting 12%, so that difference is 6%. Would you be losing out 6% on an opportunity cost? No. So always check the opportunity cost before investing. Checklist number 4, risk. Of course, this is a very different ball game. Risk is something which you should and which you have to adjust in your portfolio to understand what it is, how it can be managed. Risks can be of different types. Stock market investments has got a different kind of risk. Real estate investments has got a different kind of risk. Cryptocurrency investments has got a different kind of risk. And there are numerous other investment avenues, hedge funds, private equity, venture capitals. So all these investments, any kind of investment you think of has got a set of risks involved with it. So you have to analyze all those risks before you invest in any financial product. So risk is also one of the prime important factor in your checklist. Then there are 2 ratios I'll just touch base upon these ratios, but I'll discuss these ratios in details further in different videos. Number 1 ratio is your ratio on investing versus your goals. So what is the ratio between your investments and your goals? The ratio between your investment and your goal is how much are you investing to fulfill a particular goal that you have in your mind. Okay, so that is the ratio. What percentage of your salary, what percentage of your income are you pushing forward to invest so that that particular goal which you have in mind, which you have a date set for, that particular goal is achieved nicely. So are you properly allocating that percentage of your income, of your salary towards your investment to meet that goal? So it's your investment to your goal ratio. Checklist number 6, the second ratio is your expenditure to income ratio. So how much are you spending versus how much are you earning? So your expenditure to income ratio, this is very much important because most of the time it's seen that people spend more by swiping on credit cards and then start paying off in the credit card EMIs. That's not a very good way of living a life. So truth be said, have a check on your investment, have a check on your investment to goal ratio, have a check on your expense to income ratio. Checklist number 7, rules in investing. So there are certain rules in investing as to how much you should be allocating, what are the rules we can discuss. There are almost around 11 or 12 rules which you should follow. I wouldn't say which you should follow, but it's a rule that has been made for investors, for small investors who find it difficult to manage their money and manage their investments. It's for them. If one can follow all those 11 or 12 rules, he might find it very easy to manage his investments and manage his finances well. So we'll discuss those 12 rules in a different video. Otherwise, this is going to be a very long one. So just remember point number 7, follow the investment rules. Checklist number 8, prioritizing expenses and investments. Prioritizing expenses? No. Prioritizing investments and then your expenses. Okay? The reason why I said this, because you should always invest first and then spend what is left. By doing this, you will automatically develop a habit of investing, and also your expenses will be at check. So if you have 10 rupees coming in and you are investing 2 rupees or 3 rupees into your investments, the remaining 7 rupees is for you to spend. But if you spend first, you're going to spend all the 10 rupees. There will be no 3 rupees left for you to invest. That's a guarantee. So first invest the 3 rupees, 2 rupees, whatever be the ratio, whatever is comfortable for you, and then invest the remaining amount. Checklist number 9, use tax-effective instruments like HUF, trusts. We discussed this earlier in the wealth building chapter and wealth protection chapter rather. So HUF and trusts, they provide a kind of cocoon. They provide a safety, a security. They keep you as an individual away from your investments. Also, they provide a separate tax bracket. Like HUF has a different tax bracket. Trusts have a different tax bracket. If you have an HUF income, if you have an individual income, your individual income will be taxed separately. Your HUF income will be taxed separately. Your individual income has a tax exemption limit. Your HUF also has a tax exemption limit. So say suppose you have a 5 lakh of tax exemption in your individual income, and you also have a 5 lakh of tax exemption in HUF. So if you have a 10 lakhs of tax exemption, you can earn 10 lakhs in a year without paying a single rupee in taxes. And also on top of that, if you have a trust or if you have any other legal body that allows you to save on taxes, so you can use that too and earn more, yet not pay a single bit into taxes. Okay, so use these tax effective instruments, very effective. They are really great instruments that the government has provided us. Use them effectively. Checklist number 10, try and look for less risky products like non-volatile. Don't go with FDs because FDs do not provide inflation adjusted returns anymore, but look for something which gives sort of secured returns, not as secured as FD, but at least much more secured than the stock market or much more secured than any other volatile instruments like bitcoins or cryptos or any, or if you do a risk ratio analysis, if you find if there is anything riskier, find more safer investments to balance out, to protect your portfolio a bit. Something like invoice discounting, something like bonds. Okay, so these are the 10 checklists that you should keep in your mind handy, and always refer to these points before you invest on any product. Okay, this will help you a lot. Till then, SG signing off. Goodbye.